longer. You've been saying it. You've been proven right. What are the opportunities? What are the risks associated with that?
Well, there's always both, right? So we'll start with opportunities. I think what's happened in this higher for longer environment, coupled with a massive increase in liquidity across markets. I mean, there is certainly, as we look out and look at deal flow, just markets in general, there's a lot of liquidity just sloshing around out there. So when you have the combination of very nice high rates and a lot of liquidity, the liquid parts of the market, the public parts of the market versus the private parts of the market, look very good to us right now. I mean, that opportunity of private debt versus public debt, private equity versus public equity, the tables have turned a lot.
Wait, I thought everyone loved private credit. I thought that was the jam. Like that was the new FOMO.
It is. It has been, and it has doubled in size in the last couple years, which always is a warning sign for credit people. You know, we look at that, we go, wait a second. But I think the dynamics of locking up your money for a long period of time is good when you want to avoid volatility, but it's not so good when you want to take advantage of volatility. And that volatility I'm talking about is what's happened with interest rates. So if for example, right, you're in the bank loan index, public market, very large, very liquid, earning 9.5%, 10%. That's around the 80th, 90th percentile as far as yield, overall yield. Like retirees don't eat spread, they yield, right? So yield at that sort of rate, that's great. I can get that in a public market with transparency and liquidity. If I don't like it, I can sell it. Yeah. Or I can get stuck in a private debt fund and lock up my money for the next 5-10 years.
But is that going to change, though? I mean, let's face it. I mean, one of the reasons why we saw that money go into private credit was because the yield was there, at least before interest rates went up to 5%. So, I mean, the differential between what you can get in private markets versus in public markets was enormous. And now, I know that gap is narrowed, but you have a lot of people betting that rates are going to come down. Does that change the dynamic?
Well, again, it's in the backdrop, if you believe in higher for longer, which we do, and I really...
What does longer mean, though?
3, 4, 5 years. I mean, I definitely think this is more of the normal environment versus what we had before. A lot of the private equity and private debt was put on because of the zero interest rate world that we lived in. And in that scenario, it makes gobs of sense. It makes tons of sense. But in the world we're in now, where rates are higher permanently, you know, let's say rates come down and we go from 5.5 to 3.5. Where do you think the 10-year is going to be? It's not going back down to 2. You know, could that normalize at 5? Sure, that could happen. Those were all environments where what we're doing in liquid public markets would be quite attractive.
When you look at the money that's already in some of these private credit and private equity vehicles, now money for a lot of folks that's locked in and potentially for a significant amount of time here, and you talk about the opportunity costs that they miss. What sort of, I guess, gets them back on board, I guess, whenever their vintages come due, and assuming they actually get paid when they come due? which I mean, you laugh, but you know,
well,
some of you guys are sweeping a little stuff under the rug here.
Well, and as long as it's working, as long as the returns are there, that's not really. It's been a great. I'm not saying it's been a bad allocation or it's been a bad risk-adjusted return. What I'm saying is that relative to what we're doing, it's not so great. So the way you have to do that, if you are an allocator or a pension fund and you're in these allocations, you have to look to secondaries. Or you have to lever the fund to find the liquidity to do that. You got to sell something because they're fully invested. So, or some have cash, but I'm just saying from a relative basis, this mega trend of from private to public, I think it's durable. I think it's something that we will see much more of going forward. A lot of the PE guys now are focused on secondaries because people want to get out of their exposures, and that's an interesting dynamic. That's going to be something that's going to be much more durable as a return stream. But really, that's more private equity and venture and places that they're not getting any realizations, so they want to get out. But I'm thinking it's going to start coming in private debt too. So that's kind of the call.
So that's sort of where the opportunity then may lie, right? But what about the risks? I mean, with higher for longer, like what gets hurt? What are you most worried about?
Well, it's always two things. we're nervous. We're credit people, so we're always
nervous.
nervous
For sure.
Yeah, we've been bullish, which is weird for credit people to be bullish, but to be the things to be worried about are always credit risk fundamentals. The U.S. economy looks pretty good, and it looks like it's in a period where there's plenty to worry about. Most of those risks were above ground. We know about Ukraine. We know about the politics that we're facing. We know about the deficit, and even with all of that, we've got a pretty good corporate economy. It looks pretty good, and it's
better than the regular economy, or
which is a great,
which is good for the stock market.
So I think from an opportunity set, that's going to be supportive of credit, and it's going to be supportive of yield, and it's going to be supportive of taking a little more risk, corporate risk in your portfolio. So that's all good. The risks that we see are obviously what's happened with covenants and what's happening with the way these cap structures are built and what's happening with all this liability management exercise that we talk about. It's not been good. I mean, if you look at the defaults that we've had, the recoveries have been low because of all the shenanigans, and a good active manager who knows what they're doing is going to avoid that stuff. That's, knock on wood, let's hope we can do that. But you get stuck in that stuff, that's a risk. That's definitely a risk, and it's out there, and you've got to do your homework, and you can't get complacent about the risks.
Before we let you go, there's another risk, which is we've been waiting for the wall of Treasury issuance to hit investors and for them to kind of flee and have that Liz Truss moment, right, where they push back against how much government spending. Yeah. Is that a risk?
Oh, totally. But I don't know what to do.
When is it a risk? Like, when do you feel it as an investor?
When we pass the point where interest costs are bigger than the military budget, and we're in this place where it's 700 and something billion a day in interest expense. I mean, these are crazy numbers. One of the things that I was looking at is if you look at the average maturity of Treasury debt, and you look back 5 years and you look back now, it's about the same. So our Treasury secretaries, Mnuchin and Yellen, did nothing to avoid this massive. They knew rates were going higher.
Oh, yeah.
They could have issued longer bonds and extended the debt.
Oh, yeah.
And so here we have ourselves where the cost of debt is rising dramatically for us.
Yeah.
Yellen's funding most of the government in T-bills, which is the most expensive part of the curve.
Yeah, preach.
And and so that is definitely something where the rubber's going to meet the road at some point here. Yeah. And the bill's going to come due, and I think the reason why we're comfortable is because the American exceptionalism continues. So let's hope it does continue from here. Because if it doesn't, we have a Liz Truss moment. That would be horrible.